Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is popular platform speaker, software vendor, and best-selling author, Curtis Cloak. Hi everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're addressing why science and math are the retirement planning reference points, featuring Bernoulli's formula, all from Curtis's popular presentation, Cracking the Retirement Code, and his best-selling software, The Annuity Bulldozer. Well, I have to say, we're going to get into some serious science this week and really talk about some math issues, and there's nobody bigger that I know than Mr. Bernoulli. But before I get to him, I want to get to the patron saint of bonds, right? We're going to talk about William Gross. Tell me why you brought this in, because I kind of like your thinking here.
Well, Bill Gross has been recognized for many years as the bond guru of the world, and obviously we all know in the industry that there's been a number of media-worthy conversations to have about Bill and this change of venue and all that sort of thing. But he still has earned his wings in terms of his credibility in the bond world. And he made some interesting statements right after the crash of 2008. I think these comments were made. I know they were made in the Investment News magazine. I think it was like the spring of 2009. And he made a statement that said, look, guys, we will not revert to the mean. So we'll put the mean in context. The mean in context is the average return of the average market, U.S. marketplace. So really, if I were to put skin on those bones, I would say if we were talking about the average market, the representation we know is the S&P 500. And we also believe and can prove out that passive investment over a long, long period of time are pretty efficient. They pretty much consistently, day in and day out, year after year, perform in a similar way. Very, very narrow range of variability. And he's saying that there are some events that are going on now that will cause the variability to probably not change, but the averages are going to diminish. And I found his comments to be quite interesting. He said there's a near certain probability that the financially based global economy of the past half century won't return. That doesn't necessarily mean it won't be efficient, it just won't be the same. So if we were to take a look at the nominal returns over the past 30 years, 50 years back, it's going to be somewhere between 11 and 12. If we were to go 30 years from now and do a 30-year look back, we're expecting that average will be less. And here's the three reasons he gives, and I think they're compelling. One, and we talked in a previous session about the CBO and entitlements in this country and how we've got to make a lot of decisions with Medicare and Social Security, but increased taxes, that we have to. We're going to have to deal with increased taxes. Increased volatility. This is an interesting one. How many of you are aware recently the story about what happened to that hiccup in the market 3 years ago? And what they found was there was a smart guy in his underwear in a London apartment. He was a bright man with a powerful computer, and he created an algorithm to do a falsetto buy, sell 12 times in a literal second to move an entire market so he could buy at a discount investments in the market. And they couldn't figure out what caused this flash crash, as they called it, until they did an investigation. They found out 3 years later, it's one guy in a single apartment on a powerful computer with a bright mind in his underwear. Now, I want to say, if that's possible and we caught him, and his particular deal caused the flash crash, how many of these things are going on do you think we don't know about that aren't causing a flash crash? And then lastly, what about the legal math and science of algorithms that on a millisecond basis take profits out of the market that is technology 10 years ago couldn't be possible, 20 years ago couldn't be possible? And so those average returns are based upon no technology like that. Now the technology just catapults. And that means we're going to be taking profits, millisecond profits out of the market, both legally and illegally, around the globe. And so we won't see the same averages. The old buy and hold strategies that performed X amount probably won't be the same X amount. And then lastly, lower growth rates. No entitlements, we can't afford things, and so we're going to see low growth rates in this country for a very, very long time to come.
Wow, and do you think he's being proved out right now? Because he quoted this a couple years back.
Yeah, I think he's being proved. I think it's a very logical conversation to consider. I think it's debatable. There's people that want to debate it, but I think it's a very logical concept.
Now, here's a great guy that we all love. This is Dan Bernoulli, a Dutch mathematician.
Yep.
Why do we care about this formula here, which I don't want to go into? you know.
Well, this is a gift to the world, Steve. I mean, basically, what this gift is, and I'm going to decipher it in English language. This is the expected value equals the odds of gain times the value gain. And if you want to think about it just real simply, there's a whole bunch of people standing in the desert in some beautiful buildings with guides on gaming figure out this formula, right? However, if I'm making a bet, would I rather be the house or would I rather be the bettor?
The house.
Okay. Why? I call that the law of large numbers. The significance of this whole conversation is that, you know, if we play long enough, we'll both be in the limelight and we'll be at the bottom of the doghouse, right? We'll win and we'll lose. But for us to consistently win back-to-back periods is unlikely that we would. Now, that doesn't mean luck won't allow us to win back-to-back if luck has its way. But the reality is, if we win back-to-back, it's probably not skill. It's probably luck. And when we've been doing retirement planning as long as we've been doing retirement planning in the U.S., and we're tying all the assets to the market for things we can't control, we're really building a retirement plan that's solely based on luck of success or failure. And what I'm suggesting is that we use Bernoulli's concept of knowing how to use the law of large numbers to take a portion of the portfolio off and buy the income that uses the tenets of math that builds skill into the math of the guarantees rather than the luck of the tethered assets to the market. So I'm going to still bank on the market for some of my portfolio, but I'm going to buy time so it's efficient. And I'm going to buy income using insurance guarantees because I'm bringing skill, the math and science, the law of large numbers, which insurance manufacturers do to take longevity risk off the table. And so I use this to have that conversation about the law of large numbers and taking longevity risk off the table.
Many times I have clients and some security advisors always ask me, how do they make money on this? Well, it's the law of large numbers. Not everybody dies the same time. Not everybody's taking income at the same time.
Same premise as Las Vegas and why those beautiful buildings exist out there in the desert, because the house wins due to the law of large numbers. And if we bank our retirement on income guarantees based on law of large numbers, we'll have time for everything else to be in the market for the duration of what's necessary to make that successful.
Well, for more information on how you can use Curtis's revolutionary retirement strategies with your clients and prospects to expand your practice, just click on the landing page address in the video description. We'll be right back with more from Curtis Cloak.
This is your website. Few people visit, and if it isn't attracting new visitors, it's not doing its job. Now you can drive more visitors to your website through dynamic content and email marketing with CreativeOne's Social Media Elite. Capture quality leads faster and easier. Engage your visitors with informative articles and videos to boost your online credibility. Plus, stay connected with existing clients and earn more referrals. All content is customized for you. It's time to introduce your website to the world. Call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're addressing why science and math are the retirement planning reference points and the difference between nominal and real returns, all from Curtis's popular presentation, Cracking the Retirement Code, and his best-selling software, The Annuity Bulldozer. Well, let's talk about it. Math and science is what we live on. We don't live on your opinion, your bias against products. We live on the true math and science. Let the chips fall where they may. Curtis and I are agnostic. We really don't care what you believe in, what products you have, favorite products or so forth. I'm just looking at math. This is the biggest debate that we're going to have out. It doesn't matter if you're security, insurance. It doesn't matter if you're a consumer that's somewhat aware of what we're talking about. What is nominal returns? What is real returns? Curtis.
Well, I love the Thornburg Investment Real Return Study. These guys do a great job. Been doing this about 15, maybe 16 years. As a matter of fact, the most recent version of this report was released last week, so this is now a year old. But Thornburg's been basically, this chart just simply identifies the S&P 500 index, and they're looking at the end of December 2013, 30 years back. It's always a 30-year look back. And what we see when we look at this chart is that if we just look at what the pure returns of what the S&P does, we'll call that the nominal returns. It did 1109. And if we look at all the 15 years with a historical study they've done prior to this particular report, you'll see that range is somewhere between 1.25, 1.5. That's a very narrow range of what is efficient. And the reality is nobody gets that. And we're not talking about pure returns to the market now. We're saying, what does a consumer literally get over those 30 years where all I'm doing is I'm accumulating money, no distributions, just accumulating dough. Nobody gets that 11%. Despite what Dave Ramsey says, despite what whoever wants to say it, that may be the passive performance of a benchmark or an indice, but it does not represent what a client or consumer can expect. Let me explain. Understand, for that math to be true, first of all, that it's a single deposit with no additional deposits or any withdrawals. That's like saying if 2013, December, was your finish line for retirement, that's like saying all the money you're ever going to have 30 years later, you had 30 years before. Who do you know that's true of? Don't know anybody. Okay? Second thing is, if you did have all the money you need for 30 years from now, you all put it in the S&P 500. You don't diversify it. Well, who's going to do that? I don't know anybody that would just put it all in one indice or sector of the market. And thirdly, this is the most difficult one to imagine. No matter how volatile, no matter how ugly the market gets, and no matter how close to the finish line it is, you don't flinch. This isn't going to apply to anybody. So these are nominal returns. They don't mean a whole bunch other than to say what's the raw return of the market. Why? Well, here's why. Because where do we live? People live in a fee world. So we cannot get this because we're not the S&P. We can't buy when they buy, sell when they sell, get their strike prices. So we'll go to a Vanguard, or we'll go to a Fidelity, we go to an index fund to try to emulate the market. See, these organizations still can't get exactly what the S&P does, but they get close. They don't do it for good looks. And they don't do it for free. They do it for a fee. And it's legitimate. They're legitimate businesses, and they got bills to pay. So they build in, assuming an advisor's involved, a 50 basis point fee drag. It's 0.5% of fee drag we're talking about. So reasonable fee drag expectations. They're using traditional tax. Of course, we're speaking about non-qualified sources of money, not qualified. So once dividends and capital gains come into play, they're taking into account tax effect, and then they're interpolating a 3% level of inflation. And when all that math is considered, what we see is we haven't quite hit 6%. Just as quick as that rolls off the tip of my tongue, let me tell you something, Steve. Nobody gets 6% either. And you go, why? Because people buy when they shouldn't buy, and they sell when they shouldn't sell. I'm going to talk about another measurement, same duration, 2013 to 1983. And the Dow bar is a company that focuses on behavior of the investing consumer space. And so you're going to see, let's just go to the 3-year mark here. You can see that the dark blue area represents, in the last 3 years alone, what the S&P has done, just as a raw benchmark of nominal returns. And the green represents the equity investors and what they do when they buy and sell when they shouldn't buy and sell. The red, represents just the average bond Barclays, the corporate bond index of the U.S. marketplace. And the light green represents what happens when U.S. bond investors get involved and they buy when they shouldn't buy and sell when they shouldn't sell. Now, if we ignore what the raw market did, and we look at what happens in a 50-50 blend with the average U.S. consumer in the last 5 years, their average nominal return was 5.79. Not bad, by the way, actually pretty good. And because we've been climbing out of this really bad hole since the crash of the market, it even gets better because we've been climbing for 6.5 years. So when I do the same look at nominal returns, it's quite healthy. It's 8 3/4. But what happens when I start putting time on this thing? Well, it gets really interesting. Because when I put time on this thing, 326, that's a 10-year period. 20-year period is 287. And look at that. The 30-year period is 2.2. Now understand I've taken no adjustments for fee drag taxes or inflation yet. And if I have a 3% level of inflation, I'm not increasing my position at all. When advisors are involved, they say that we do twice as good. We do 440 instead of 220. My point is that the performance numbers that we're using to project retirement, successful retirement, is irresponsibly being overstated. And we need to get a good handle on what reasonable rates of return and projecting retirement really are.
Well, this is a shock and awe graph, I have to say, and it really spells out the reality of what we're getting in. If we're looking at real numbers, and I do like here, we have to be careful how we frame this. Nominal versus real returns. Is it all in fees, the fee that's charged by the advisor, the taxes, the inflation. We have to incorporate all this into our thinking. And this is kind of new for many people because we're always quoting the gross, never doing the actual net result to the client. Wow. Well, for more information on how you can use all this information in Curtis's revolutionary retirement strategies with your clients, and just go ahead and click on the landing page address in the video description. And for more information on our shows, seminars, and workshops, just follow us on social media or visit us out on our website. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.